The Psychology of Money by Morgan Housel. Introduction: The Greatest Show on Earth. Let me tell you about two men. One was a janitor, the other was a Harvard-educated Wall Street executive. And here's the twist: the janitor died richer. Ronald Read spent 25 years fixing cars at a gas station and 17 years sweeping floors at J.C. Penney. He lived in the same modest two-bedroom house he bought for $12,000. He chopped firewood as a hobby. Quiet life, invisible man. When he died in 2014 at age 92, he left behind $8 million, most of it donated to his local hospital and library. Meanwhile, Richard Foscone, the Harvard MBA, the Merrill Lynch executive, the man praised for his business savvy and sound judgment, borrowed heavily to maintain an 18,000-square-foot mansion with 11 bathrooms, 2 pools, and 7 garages. When 2008 hit, everything collapsed. He declared bankruptcy. His mansion was sold at foreclosure for 75 cents on the dollar. The janitor outlasted the genius. This is the central puzzle Morgan Housel sets out to solve. Why does financial success have so little to do with intelligence and so much to do with behavior? That question is the spine of this entire book, and the answer will probably surprise you. Chapter 1. No one's crazy. Here's the first uncomfortable truth. Nobody is actually crazy with money. They just come from different worlds. Think about it. If you grew up poor, your relationship with money is shaped by scarcity. Every dollar feels like survival. If you grew up wealthy, money feels like a tool. If you lived through hyperinflation, you don't trust banks. If you grew up in a bull market, you're fearless with stocks. If your parents lost everything in a crash, caution runs in your blood. Housel points to a powerful economic study that tracked 50 years of American consumer behavior. The finding was striking. People's investment decisions were almost entirely shaped by the economic conditions they experienced in their early adult years, not by what was objectively smart. Your personal experience with money is maybe 0.000000001% of all human financial history, but it accounts for roughly 80% of how you believe the world works. That's not stupidity, that's just being human. So the next time you see someone buying lottery tickets when they can't pay rent, don't shake your head. Understand this: for someone who has no path to wealth through conventional means, a lottery ticket might be the only affordable dream they can purchase. That makes emotional sense, even if it makes zero mathematical sense. The lesson? Before judging anyone's financial decisions, including your own, ask what world they grew up in. Chapter 2. Luck and Risk. Bill Gates went to one of the only high schools in the world that had a computer in 1968. That wasn't skill, that was luck. His close friend Kent Evans had the same drive, the same intelligence, the same access. He died in a mountaineering accident before graduating. That wasn't failure, that was risk. This is Housel's second big idea. Luck and risk are siblings, and we are terrible at telling them apart. When someone succeeds wildly, we call it talent and strategy. When someone fails, we call it poor decisions. But the truth is far messier. The same forces that push one person to the top can destroy another. The difference is often just a coin flip they never saw coming. This has serious practical implications. When studying success, beware of survivorship bias. For every Bill Gates, there were thousands of equally hungry, smart, driven people who simply didn't get the lucky break of a computer lab in high school. We never hear about them. The lesson Housel draws is simple but powerful. Be humble about your successes and compassionate about others' failures. You probably had more luck than you think. They probably had less than you imagine. Chapter 3. Never Enough. In 2008, 2 hedge fund managers had built fortunes worth hundreds of millions of dollars. Rajat Gupta had $100 million. And yet, he risked everything, including his freedom, by trading on insider information. Why? For more. He already had enough to live 100 lifetimes in luxury, but enough had never been defined. And when you don't know what enough looks like, you keep chasing until the chase destroys you. This is one of Housel's most important warnings. The most dangerous financial disease is not poverty, it's the inability to say enough. The goalposts keep moving. You earn $50,000 and think $100,000 will bring peace. Then it's $500,000, then $1 million, then $10 million, and each time you arrive, the feeling evaporates instantly, replaced by comparison to someone with more. The wealthy people who truly win, not just financially but psychologically, are the ones who define their finish line early. They decide what enough looks like in comfort, in safety, in freedom. And when they get there, they stop. Because the trap isn't losing. The trap is winning, but never feeling like you have. Chapter 4. Confounding Compounding. Warren Buffett is, without question, one of the greatest investors in history. But here's what most people miss. The secret to his fortune isn't how he invested, it's how long he's been doing it. Buffett started investing at age 11. His net worth at age 65 was about $3.8 billion. Sounds incredible, right? Except 99% of his wealth was earned after his 65th birthday. Today, he's worth over $100 billion in his 90s. Had he started investing in his 30s like most people and retired in his 60s like most people, you'd never have heard of him. He'd be a modestly successful investor worth a few million. The secret wasn't returns, it was time. Compounding is the most powerful force in personal finance, and it is also the most profoundly misunderstood. Our brains are not wired for exponential growth. We think in straight lines. Compounding moves in curves, slow, invisible, then suddenly explosive. The practical takeaway is almost embarrassingly simple. Start earlier. Stop interrupting growth. The single biggest financial mistake most people make is not investing poorly, it's waiting too long to start. Chapter 5. Getting Wealthy versus Staying Wealthy. Building wealth and keeping wealth are completely different skills, and most people who are brilliant at one are surprisingly bad at the other. Getting wealthy requires boldness, taking risks, being optimistic, putting yourself out there. But staying wealthy requires the opposite mindset: paranoia, humility, and a quiet terror of losing what you've built. Housel uses Jesse Livermore as a cautionary tale. In 1929, Livermore shorted the stock market just before the crash and made $100 million in a single day, one of the greatest trades in history. But he couldn't stop. He kept trading, kept swinging, kept pressing his luck. He died broke. The people who stay wealthy share one common trait: they never assume the future will look like the present. They maintain what Housel calls a survival mentality, always keeping a cushion, always preserving optionality, never betting everything on a single outcome, no matter how certain it feels. Getting rich is impressive. Staying rich is wisdom. Chapter 6. Tails, you win. Here's a fact that changes how you should think about everything. In most fields, a tiny number of outcomes drive the overwhelming majority of results. In venture capital, most investments fail completely, a few break even, and one, maybe, returns 100 times and pays for all the losses and more. The entire model depends on rare, extreme outcomes. The same is true in investing broadly. The stock market's long-term gains are driven by a handful of exceptional years. Most years are mediocre or negative. Miss the 10 best days in the market over 30 years and your returns collapse. The insight is this: you don't need to be right all the time. You need to be right when it really counts and survive long enough for those moments to happen. This is why Housel argues that failure, mistakes, and losses are not signs that your strategy is broken. They are the cost of admission for being in the game long enough to catch the tail events that transform your financial life. Stop trying to be perfect. Focus on not quitting. Chapter 7. Freedom. Ask someone what they want from money, and they'll say, more money. But push a little harder and the real answer emerges: they want control over their time. They want to wake up and decide what they do with the day. They want to not check their phone out of anxiety on a Sunday. They want to say no to a client or a boss without their hands shaking. Housel argues this is the highest form of wealth, not the yacht, not the penthouse, not the luxury watch. It's the quiet, invisible power to shape your own hours and days according to your own values. And he makes a crucial point. This kind of freedom doesn't require being ultra-rich. It requires living below your means, building a financial buffer, and making intentional choices about what you actually need versus what you've been told to want. The irony of modern consumerism is this: we buy things that compress our freedom, cars that require constant income, houses that chain us to mortgages, lifestyles that trap us in careers we hate. We trade time for money to buy things that cost us more time. The reverse is radical, but it's available. Spend less, save more, protect your time above all else. Chapter 8: Man in the Car Paradox. You see someone driving a Lamborghini, what do you think? You think that person must be cool, successful, admirable. Here's what you almost certainly do not think. I wonder what the driver specifically is like as a person. Housel makes a devastatingly sharp observation here. Nobody buys a Lamborghini and thinks, people will admire the car and still see me as average. They buy it because they expect people to admire them through the car. But that's not how it works. The observers admire the car and barely register the driver. They project their own fantasies onto the vehicle, imagining themselves behind the wheel. This is the paradox. We buy symbols of success hoping to be seen, but the world only sees the symbol. The broader implication: if we're honest with ourselves, most of our status-seeking spending is invisible. No one is as focused on your possessions as you are, so the entire premise of buying things to signal wealth, to earn admiration, to feel validated, is a transaction where you pay real money for a return that largely doesn't exist. The genuinely wealthy people who found peace stopped caring about being seen. They bought freedom instead. Chapter 9: Wealth is what you don't see. Following directly from the car paradox, wealth is invisible. The person with the biggest house on the street isn't necessarily the wealthiest. They might have the biggest mortgage. The most apparent consumption is often just the most apparent debt. Real wealth is what you don't see. It's money not spent, assets not displayed, options not exercised. It's sitting quietly in an index fund. It's a savings account that lets you take a career risk. It's the space between your income and your spending. The problem is that we model our financial behavior on what we observe. We see people spending, so we assume they're wealthy, so we try to imitate their spending. But we're actually just imitating the appearance of wealth, not wealth itself. Housel's point is blunt. The only way to build real wealth is to not spend money. That sounds stupidly obvious, but most people never act on it because the cultural pressure runs 100% in the opposite direction. Chapter 10: Save Money. This chapter is short and almost brutally simple. You don't need a high income to build wealth. You don't need to be a brilliant investor. You don't need perfect timing. You need to save, consistently, more than you think is necessary. Housel makes the case that savings rate is the single most controllable variable in personal finance. You can't control market returns. You can't control inflation. You can't control your company's stock price. But you can control how much of your income you keep. And here's the part most people miss. Savings doesn't just create wealth, it creates options. A 6-month emergency fund isn't just protection against job loss. It's freedom to quit a job you hate. It's ability to take a calculated risk. It's psychological calm during a market crash. The fastest path to growing your savings rate isn't earning more, it's wanting less. Specifically, it's reducing the need to keep up with a lifestyle inflation that serves no one but advertisers and your ego. Save like you don't need to impress anyone, because you don't. Chapter 11: Reasonable, not rational. Here's a counterintuitive idea. The mathematically optimal financial strategy is not always the best one. Pure rationality says, If stocks historically outperform other assets, you should be 100% in stocks. No emotional considerations, just the math. But nobody lives inside a spreadsheet. A strategy that makes you panic sell at the bottom of a crash is infinitely worse than a slightly suboptimal strategy that you actually stick to because you stuck to it. Housel argues that the goal should be a financial plan that is reasonable, one that accounts for your emotions, your risk tolerance, your sleep quality, your peace of mind. A strategy you can maintain for decades without abandoning at the worst possible moment. This is why he argues it's perfectly fine to hold a bit more cash than the numbers say you need. It's fine to invest in companies you love, even if pure index fund logic says otherwise. The best investment strategy is the one you can live with. Chapter 12. Surprise. History is not a map of the future, it is a record of surprises. Every generation has experienced at least one event that no one predicted, no model anticipated, and no historical data suggested was coming. The Great Depression, World War II, the 2008 financial crisis, COVID-19. These weren't glitches in the system, they were the system. Housel's message is not pessimism, it's humility. The most important financial events are by definition the ones you didn't plan for. This means two things practically. First, don't build a financial plan that only works in favorable conditions. Build one that survives chaos. Second, don't be too seduced by historical data. The things that have never happened before happen all the time. The future will be shaped by events that currently seem absurd. Plan accordingly. Chapter 13. Room for error. The most dangerous word in financial planning is certainty. When someone tells you they're certain the market will rise, certain a particular investment will pay off, certain their income will stay stable, run. Not from them necessarily, from the certainty itself. Housel introduces the concept of a margin of safety, a buffer built into every plan specifically for the things that will go wrong, even when you don't know what those things are. This isn't pessimism. Engineers build bridges to hold 3 times the maximum expected load. Not because they're paranoid, but because they're smart about the unpredictability of reality. Your financial life deserves the same engineering philosophy. Hold more cash than the model says you need. Borrow less than you can technically afford. Plan to retire with more saved than the projected minimum. Build in room for the error you can't see coming. The people who get wiped out in market crashes aren't always the least informed. They're often the ones who planned for a world with no margin, no slack, no room to be wrong. Chapter 14. You'll change. Who were you 10 years ago? How different were your priorities, your ambitions, your fears, your idea of happiness? Now project forward 10 years. Will you be the same person as today? Of course not. And yet, we make 30-year financial commitments based entirely on who we are right now. Housel calls this the end of history illusion, the psychological quirk where humans readily acknowledge how much they've changed in the past but struggle to believe they'll change as much in the future. This has massive practical implications for financial planning. The career you're certain you'll love at 30 may feel like a prison at 45. The lifestyle you're working toward at 25 may seem hollow at 40. The retirement plan built around your current self may not serve your future self at all. The solution isn't to refuse to plan, it's to build flexibility into your plans. Avoid overcommitting. Keep options open. Don't lock everything into a single vision of the future that assumes you'll remain the same person for the next 3 decades. You won't, and that's okay, as long as your finances can adapt. Chapter 15. Nothing's free. Every financial reward comes with a cost. The mistake people make is trying to get the reward without paying the cost. Stock market returns are extraordinarily good over long periods, but the price is volatility, watching your portfolio drop 20%, 30%, even 50% during crashes, with no guarantee of when it recovers. Most people look at this price tag and think, there has to be a way to avoid the dip and keep the upside. So they time the market, they move to cash, they buy complex hedges, and in doing so, they usually miss the recovery and end up worse off. Housel reframes this entirely. Market volatility is not a penalty, it is the admission fee. You don't pay it, you don't get in. The same principle applies across financial life. Building a business means years of uncertainty and stress. Investing in real estate means dealing with bad tenants and maintenance crises. Every path to wealth has its specific non-negotiable cost. The question is never, how do I avoid paying? The question is, which costs am I willing to pay? Pick one. Pay it honestly. That's how this works. Chapter 16. You and Me. Here's something the financial media will never tell you. You might be playing a completely different game than the person giving you advice. A day trader optimizing for short-term volatility and a long-term retirement investor optimizing for 30-year compounding should not be making the same decisions, but they watch the same news, read the same analysts, follow the same market commentary. The day trader bidding a tech stock up to absurd valuations isn't irrational. For their game, they plan to sell in 4 hours. But if you're a long-term investor watching that same behavior and thinking, maybe these valuations are justified, you've started playing someone else's game with your retirement savings. Housel's warning is sharp. Know what game you're playing, and make sure every piece of financial advice you consume is relevant to that game, not someone else's. Most financial disasters don't happen because people are foolish. They happen because smart people, accidentally, start playing the wrong game. Chapter 17. The Seduction of Pessimism. Bad news sells, always has. Pessimism sounds smart, optimism sounds naive. If someone tells you the market will double over the next decade, you shrug. If someone tells you it will crash 50% next year, you pay attention. Our brains are wired this way. Threats demand focus. Good news can wait. This creates a dangerous asymmetry in how we consume financial information. The loudest, most confident voices in media and finance are often the bears, the ones predicting collapse, crisis, recession. And they sound so intelligent when they do it, so specific, so data-driven. But Housel makes a critical observation. The world has always been about to end, and it has never ended. Every generation has had its list of reasons why progress should stop: wars, pandemics, technological disruption, political chaos, and every generation that stayed invested, stayed patient, and trusted in long-term human ingenuity came out ahead. Pessimism is not wisdom. It's often just anxiety wearing a suit. Optimism, not blind, reckless optimism, but the historically supported belief that human beings figure things out over time, is the only rational long-term financial stance. Chapter 18. When You'll Believe Anything. When the market crashes, something strange happens to smart people. They start believing things they would have laughed at in calmer times. People create narratives to explain what they're experiencing. And in times of financial stress, those narratives can get dark and distorted very fast. Conspiracy theories spread. Collapse scenarios feel rational. Doomsday predictions gain mainstream credibility. This isn't stupidity, it's neuroscience. Our brains hate uncertainty. They will generate any story, no matter how extreme, to replace chaos with a sense of cause and effect. Housel's lesson: be especially skeptical of the stories that feel most compelling during moments of maximum fear or maximum euphoria. Those are exactly the conditions under which your brain is most willing to believe anything that confirms what you already feel. The antidote is boring but powerful. Build a financial strategy based on principles that don't require you to predict the future, then ignore the noise. Chapter 19. All Together, Now. In this chapter, Housel synthesizes the core principles into a coherent philosophy. It's not a formula, it's a mindset. Save more than you think you need. Not for a specific goal, but for the optionality that savings creates. Savings is freedom. Build a margin of safety into everything. Debt is the enemy of margin. Live below your means, not as a punishment, but as a strategic position. Be long-term greedy, not short-term greedy. The investors who get rich and stay rich are the ones who resist the temptation to optimize every quarter. They think in decades, respect uncertainty. The future is genuinely unknowable. Any plan that requires the future to behave a certain way is fragile. Build plans that survive being wrong. Don't let admiration of others define your goals. Define your own enough. Run your own race. The comparison game has no finish line and no winners. Chapter 20. Confessions. In perhaps the most disarming chapter of the book, Housel drops the expert pose and tells you what he actually does with his own money. He and his wife live below their means, deliberately, not out of necessity. They hold more cash than any financial model would recommend. They invest in simple, boring index funds. They have no elaborate strategy, no complex optimization. His explanation is worth sitting with. He values sleeping well at night more than maximizing returns. He values not having to constantly monitor and adjust. He values a financial life simple enough that a crisis, personal or macroeconomic, doesn't require an emergency response. This is the most honest thing a finance writer can say. I don't follow the optimal model. I follow the model that fits my psychology. And that, ultimately, is the entire message of this book. Finance is a human discipline, not a mathematical one. The best financial plan isn't the one with the highest expected return on paper. It's the one that keeps you sane, keeps you invested, and keeps you moving toward a life that you actually want to live. Final thought. The greatest lesson. Return to Ronald Read, the janitor who died with $8 million. He didn't have an MBA. He didn't have a Bloomberg terminal. He didn't read research reports. He just bought good stocks, left them alone, and lived a quiet life for decades. And in the end, his patience, his humility, and his indifference to appearances crushed the Harvard-educated executive who lived lavishly and borrowed recklessly. The Psychology of Money is not ultimately a book about money. It is a book about behavior, about patience, about knowing what you want and having the discipline to pursue it without being distracted by what everyone else appears to have. The math of wealth is easy. The behavior is the hard part. And that is where almost every financial story, of triumph or disaster, is ultimately decided.